It is, Scott. And, whether that's a response to the Fed's change of stance or not is irrelevant. What the rates market is saying is that real interest rates are way too negative. And for this strong of an economy, it just should not be negative. So interest rates are moving up. You're right to bring up the speed of this increase. That's what has hit the markets the hardest. And it's this simple. You really should not expect multiples, earnings multiples, to expand if interest rates are rising this quickly. We better hope like heck they don't contract, particularly in tech land. So, these Googles, Apples, Microsofts of the world, the FANG complex, what we should be all hoping for this year is that the multiples stay the same and you get a share price increase then that's just commensurate with earnings per share growth. What's that going to be? It's going to be like 7, 8, 9, 10%. Not a lot. If you want more than that, you got to look outside of tech where the earnings growth rate is going to be higher in the cyclical stocks. But yes, Scott, to summarize, this is about interest rates right now. The Fed has clearly turned hawkish. And what's very interesting, I thought today that maybe rates would back up a little bit, that they'd go down off of that lousy jobs report. But the rates market is saying, nope, no matter what, we're going higher. And I think we thank the Fed for that.
I'm glad you bring that up because I want to point your attention to not only a tweet, but a chart that our own senior economics reporter, Steve Leisman, put out within the last hour that really tells the story that it's full steam ahead as far as the market is concerned relative to what the Fed is going to do and when it's going to do it in terms of raising interest rates. Take a look at this. Leisman says Fed funds futures trading like this was a strong inflationary jobs report that keeps the Fed on track to hike. All these probabilities are contract highs, with the third hike now at 58% for September. The December contract, 50% probability for a fourth hike for the very first time. But you take a look at this chart now that I want to show you, 82% for March for the first hike. And now you're creeping up to 4 hikes. 50% think December is going to be the fourth hike. That's why rates are on the move, Pete.
Yep. No doubt. No doubt. Scott, I think it's really important, and I love the fact that you went back and just showed us what it looked like over the last week. That's an unbelievable velocity move that we're talking about here when we're looking at the 10-year. And obviously, all of us are looking right at that, and there's two reactions. You're getting rid of a lot of those high multiple tech stocks. That's what people are absolutely going hands out, and they're saying it's time to sell those. And they're buying stuff like we're seeing within the financials, specifically a lot of the big banks, whether it's JP Morgan or Citi or Wells Fargo, you name it, but also even some of the other names within that. And we're seeing a lot of paper, Scott, in JP Morgan, in Bank of America. I'm seeing option paper, as a matter of fact, in the XLF that's just absolutely massive. And they're not ultra short term. They're actually buying a little bit further out. So I think that's a little more interesting as well. Basically saying, hey, look, we don't think this is just a one and done week and that's where we're going to stop. They're actually basically signaling to us that through the options markets that they're looking for even more upside over the next period of time going out to the end of February. So we're seeing XLF calls like yesterday where they bought massive, I'm talking 68,000 upside calls in the XLF yesterday. That gives you a little bit of an idea that people just continually are looking at this, and they're looking at that 10-year, as Jim said. That is the trigger point right now. The trigger point to sell on one side, but then buying these financials on the other.
Shannon, what are you watching today on this Friday?
Well, I think that the one thing that I'm taking away from this morning's non-farm payrolls report is that we know that there's going to continue to be revisions there. And so I think the focus and the emphasis is rightly on the unemployment rate number, which is under 4% now. I think that there does need to be some reconciliation between the selling in big cap tech and what we would expect to see over the course of the next couple of years. I do think that I don't disagree with Jim's assessment on the opportunity for multiple expansion, but I think that there is going to be continued earnings growth in the space. And I think that the economy globally is going to be an accelerant for that. And so I think if you're looking at what I'm most interested in positioning my portfolio for over the course of the next couple of years, it's quality companies that continue to generate earnings growth and free cash flow. And I think that there are several sectors in which you can can find those opportunities. And so rather than emphasizing specifically some of the deeper cyclical names that we'll talk about later in the show, I think that people should be looking at some of the quality names in the quote-unquote growth space that could be great long-term adds over the course of the next couple of weeks. And so it's a cautionary tale on loading up on one side of the barbell, and we've always kind of been in the middle and balanced in that way. And I think it's just re-emphasizing the fact that these companies aren't bad companies and that they will continue to grow their earnings over the course of the next couple of years.